This is the MTPredictor weekly market update for July 14th. Alrighty, so interesting week. You know, we got the Fed minutes that came in, and the Fed kind of retracted a bit of the tapering comments as far as uh, basically the quantitative easing is not going away for the foreseeable future unless the jobs picture comes in line and hits their targets and inflation and all that stuff. And the market really reacted to that positively, as you can see in the chart of the S&P here. We'll get to in a second. That the party is back on. The reality is the Fed is not going to be able to begin any tapering anytime soon, and so things continue to march forward, which we anticipated. If I use the tools in the software here, and I'm just going to right click and choose the Elliott Wave Intermediate, we knew we should expect a rally, especially this unfolded right around the holiday, 4th of July. You tend to get that trend change. So the weekly trend at the moment had been, or the shorter term trend I should say, actually was down. And then after the holiday, we came into this wave 4 support, rallied off of there, and of course we had already projected up wave 5, and I told you that the S&P, based on this analysis, should be heading towards that $1,700 level on the futures contract, current contract there. Let's just project up using the wave price targets, up wave 5 here, so we can see that visually on the chart. And there it is, just slightly above 1700 is the minimum wave 5 target. And I want to watch this level as well. If we do get there, now you're going to have an overlapping weekly decision point resistance here off of the wave 3. If we hold in this, if we get to that wave 5 DP level here, and that holds as resistance, then I will anticipate a correction back to this wave 4 DP here. Let me just actually get rid of this if I can. I'll just move it over so you can see this level here. Right. If we see wave 5 up here, we can anticipate a correction back to this level, the wave 4 DP. Now the other thing that's going to come into play, or that's going to be a major point of interest, if I scrunch the chart up here, let's go back to the prior all-time high in the S&P back in 2007 here. I'm going to take a decision point. Remember, these are potential areas or turning points in the market, potential market tops and bottoms. You can see there was a DP signal. This came on the chart because there was also divergence at the bottom here in conjunction with this nice 5-wave pattern. And we've seen that all these moves have unfolded in 5 waves. So we had a 5-wave pattern up here right into the minimum wave 5 resistance, which corrected back to the wave 4 DP. Right. This next level where we got a DP sell signal here also unfolded as a 5-wave pattern up. Again, a topping pattern right into minimum wave 5. We anticipate a correction back to the wave 4 DP. This one actually went a little beyond that. And then the next that unfolded here, we had a 5-wave pattern up here. Where the DP is, again, telling us that there was a potential top here. Now this one unfolded. You see it went a little further, went into the typical wave 5 resistance area here beyond the minimum wave 5. And at the time I noted in the weekly market update that that was a change in the pattern where it had previously hit minimum wave 5s and began the correction into wave 4. Minimum wave 5 into wave 4. This one was different. It went into the typical wave 5. So maybe a little more strength on this up move, and therefore the pullback was not to the wave 4 DP. Wasn't able to make it. Instead, we got a new high, another 5-wave pattern. There's wave 3. That's why when it hit the wave 3 target, we were expecting a pullback into wave 4. Hit the wave 4 target there, and head into now potentially into this minimum wave 5. So I want to watch this minimum wave 5 and then the typical wave 5 area above that around 1800. Right, in conjunction with this is the DP off of the last all-time high in the Dow back into or in the S&P back in 2007. So now we got a confluence in minimum wave 5 of major resistance there around that 1700 level. All right. Now the typical wave 5 also is obviously a large, between 1700 and 1800 there, and beyond. There's actually a large range, but and we could get a turn anywhere in here. But I want to watch these areas here to see if we correct in minimum wave 5. Then I think probably get a correction back to the wave 4 DP. If we go beyond that into typical wave 5, maybe the correction is more shallow. Some other things that are coming into play that we'll look at in a minute when we look at the Dow here. But anyway, this is so we've got we'll close at 1670, and so not too far from the $1,700 target. That's the beginning of that resistance and the beginning of that target in minimum wave 5. So an area to watch if you are long. Again, it's time to look at protecting long positions if we do get up into that 1700 level in the S&P in the futures contract. Anyway, let's look at the Dow. Let's see, 24-hour. All right, so here's the Dow again. Same picture. Wave 4 heading into wave 5. I'll just project that up again using the tools in the software. Okay. And so again, getting close to that target as well. If I put the crosshairs on that level, right around 15,720, 25 area on the current Dow futures contract. And again, we can look at the NQ, the TF. All these are the patterns are the same. If we want to look at the Russell here, again, Russell is at new all-time highs, and it is already just shy of its minimum wave 5 target there. So all these markets are in sync. That's when the moves tend to be coordinated and good, fluid. So we'll see as the other markets if they can approach their minimum wave 5 targets, where we go from there. The other thing that I've pointed this out before is this is courtesy of barchart.com. I just drew up this chart here of the Dow. This is a 25-year pattern that has been forming. This is a kind of a megaphone broadening pattern. In terms of technical analysis, it's a potential topping pattern. And you can see the top trend line. This is where you get a succession of higher highs in price and lower lows, and it forms this kind of, you can see the picture of a megaphone or broadening, what they call broadening formation. And you can see the top, if we were to hit, tomorrow, let's say, this 16,000, just 16,000 plus, we would be at the top of this trend line. You see what happened here, and at these points, the market reversed dramatically off of these levels. All right, so it depends. If we go very quickly higher, above 16,000 in a short period of time, then we'll be at the trend line. Now, obviously, if we kind of fall off here and things kind of go sideways, for a number of weeks, and then this line extends further out higher in time, and can end up being 17,000, 18,000, 20,000. It just depends. But if this hits very quickly, we come into that level, it'll be somewhere around 16,000, 16,500, somewhere around there in the Dow. That would give me some certainly concern on the up move. Now the kind of the wild card here is the quantitative easing. If that's going to continue, as those interest rates, if the Fed is able to keep control of those interest rates, where they're kind of losing control of the bond market and so forth, but if they're able to get that back under control, interest rates stay low, the tendency is that stocks will grow. And then, we could go beyond this trend line certainly, and because of that fact. So it's still important. I want to pay attention to it, and you may want to make a note of it. This pattern, and it's the same in the S&P. It's a potential market topping pattern, and you can see that the drop from there is going to be, or would be, pretty severe if this continues to play out. So just wanted to kind of bring that up and point that out as we climb towards those levels. Again, the quantitative easing kind of throws a wrench in that, because it's like the market on steroids. It's kind of an artificially induced pumping up of the stocks, while the economy may or may not follow. We'll see. All right, so that's those. If we want to look at Apple here, as we kind of continue with the stock market theme. Again, Apple went wave 5 up on the weekly chart. We anticipated ahead of time that it would correct back to the wave 4 DP, just like we were looking at in the other markets. The patterns and the analysis is exactly the same, but it broke below this $475 to $500 decision point level. We got to close below that level. That low did get taken out. That points us to further downside. Well, we did get further downside. It kind of double bottomed here, but the tendency, if they take this level out again, we go back to wave 1. Just shut this off here for a second. Go to the bottom of wave 1. We take our decision point tool. Okay, and that gives us this level here. This is the next major support level, but obviously that would really hurt the price of Apple down here. And this is something we talked about before. You take Steve Jobs out of the equation, and Apple, I don't care what anybody says and how much Jobs planned, before his passing. It's not the same company. It can't be without him. And so, this is not a surprise. I think people will be shocked, though, if Apple does trade down into this weekly TP support. Like we talked about before, this thing needs to rally. The other concern is, the markets are making all-time highs, and Apple is not, and that's kind of a concern anyway. So if this doesn't snap back above 450 to 500, it's we may eventually see this level. Let's talk about silver here. Again, I kind of mapped all this out. In fact, we did a little more just basic technical analysis in one of the prior. Let's just draw a trend line. From the tops here, we noticed, and I pointed this out a while ago, we had the descending triangle here, and we got the break below that. And this pattern usually is associated with a downtrend. You get this descending triangle, but it can happen in an uptrend, which we had. But we went wave 5 up and began to kind of this distribution, and then broke out of the triangle. And we know after wave 5 we anticipate a correction back to the wave 4 DP, and that's this level here. We've gotten that. All right, I wanted to see the weekly close this week, because last week was a holiday. Was a holiday shortened week, and I didn't want to put too much weight on it. So here was the weekly close, and we basically closed back right around to the bottom of the decision point area. And so we don't have a significant close below that weekly DP yet. Again, this did close, but it was that holiday shortened week. I'm not putting a lot of weight on that. I wanted to see what it did this week. Pretty much closed back in that area. So we do have strength on the STF here to the downside. It means there may be more downside ahead, but I think we get some type of rally here. If we go to the daily chart, and I did buy more silver, actually just the physical bullion. But in terms of the daily chart here, we went wave 5 down, and so again we can anticipate some type of rally move in the daily chart. If we get it all the way back to the wave 4 DP, it'll be this level. I already had on the chart about $25, and then we've got to watch that level. If this holds as resistance, then we may see more downside. If it breaks back to the upside, then we could see a retracement of this whole 5-wave pattern down, and there's that level there around 34 in change to the upside. But we're a bit of a ways from that right now. The other option is, like Apple did when it broke or went down to that wave 4 weekly wave 4 DP, is it's kind of gone choppy sideways, and we could kind of get that action for a while as well. We know a lot of the this divergence between the paper price of silver and the actual physical bullion. We're having not so much in the West, but in the East, the record. We've got India imported record, I think, levels of silver over the last few months, and of course the Chinese. Chinese are buying up real assets, whether it be gold and silver, but also real assets here in the U.S. As Japan, when they purchased a lot of foo-foo, high-profile assets, but the Chinese are really going after assets here in the U.S. And we're kind of starting to see that transfer from real assets, especially like you look at gold and silver, from the West to the East. And so we'll maybe talk about that stuff in another video. But all these things kind of in the background, and our central banks don't like gold because it competes against the U.S. dollar, and the U.S. dollar is the gold standard around the world, and that's what they have to purchase. The petrodollar, around the world, and we're starting to see cracks in that, where these BRIC countries looking to kind of trade around outside the U.S. dollar, and so they are buying gold there and other things. So anyway, it's just an interesting developing something to keep your eye on. I did want to get to, let's just kind of move because I used up a lot of time on some of the stock market stuff. Here's the euro here on the weekly chart. Again, that same pattern that we went wave 5 down here. We had an ABC correction into the wave 4 DP, which was, here's our wave 4 and here's the wave 4 DP here. We had a TS4 sell signal as that ABC completed in the wave 4 decision point, and you can see here we are. Let me just put the analysis on this particular setup here. We did get obviously that rally during that Fed minutes and all that around that week. We got a rally in the euro and a sell-off in the dollar there. But this is still short at this point. We'll see how this finishes out. You can see the target all the way down there around 1833 in the euro. And let me just see if we have the oops, I want to see if I've got the dollar index on here. Again, here's the weekly dollar index. Here's that major low with the high volume spike that came in on the dollar index, where we were anticipating we could get a rally at least back to this. There's the last swing into the low, at least back to this level. We've got that. We've hit 85 here. That was right around 85 and change was that kind of that next target that we're looking at. It was off this level here, right about there, and so we would anticipate a sell-off in the dollar from there. All right, so there's the sell-off. We'll see if we can take this level out in the dollar, or if it continues to sink. Obviously, we'll see that euro continue to climb and maybe get stopped out. But at this point, it's still a short on the euro on the weekly chart. In terms of the weekly chart, we'll see how that finishes out. And then this week is an important week as well. We've got the retail sales and the CPI Monday and Tuesday. But Wednesday, Bernanke will be speaking during market hours on actually Wednesday and Thursday. And so you're going to watch that along with housing starts on Wednesday and the jobless claims on Thursday. Also, Beige Book is in there, Philly Fed, and some other stuff. But it's another kind of week where Bernanke will be taking up some time during the market hours. So be aware of that. I didn't have a chance to get to oil. Again, watch that $110 level in oil. If that gets broken, 120. It hasn't been able to, for a long, long time, get above 120. And every time we've hit that 120 level, it's really gotten smacked down. We'll see, is this the time where it changes? It's been a long consolidation period in oil. We're looking for a breakout. If we get to those levels, one way or the other, to the downside would be below 80. Until then, it doesn't mean a whole lot. It's just kind of that range that it's been in, at $80 to $110 level. And then spikes to 120 and then immediate smackdowns. If we get to 110, then we'll see about 120. If they take out 120 and close above 120, it could be it's something we're going to really have to look at, because that could change, be a game changer. All right, so we'll leave it there, and we'll see you back next week for the weekly market update.